why don't you cover the next question?
Cool, let's do it. So the next question is from an episode that we did with Jason Lowe on family banking. And Dub Digital, he said, but the life insurance policy is a fixed amount. Over time, doesn't your ability to exercise the policy's purchasing power via a loan decline when compared to the real rate of inflation? So I think this is a conversation that people always like to bring up in saying that by putting money into life insurance specifically, and it's actually funny because it goes both ways. You hear people that are big into infinite banking or that are like selling life insurance to say like you want to put your money into life insurance so that you can outbeat inflation. I've heard many different reasonings how that's true. And then you hear often it's like, well, life insurance gets such a low rate of return. The growth rate on it is very insignificant relative to the rate of what inflation actually is. And first and foremost, I would say that regardless of where you put your money in, regardless of where the asset is, you're going to be competing with inflation regardless. And so you're really not comparing like, is it beating inflation, but you're really competing against like where you actually store your capital. And so if you're looking at the storage of capital to increase purchasing power, you have to just ask yourself, is it better to put it into a fixed bucket that is somewhere else, like a savings account or a money market, or something that is higher risk, like in equities, etc., or is life insurance the right asset for you? And I think it doesn't come down to is it going to beat inflation or not. It's going to come down to the utility and characteristics around life insurance that can then help give you extra benefits to everything else that you're trying to work towards, because and especially for inflation. You have to ask yourself, like, what year are we looking at inflation? Are we looking at inflation this year to 20 years ago? Are we looking at the average? Like inflation is just, it's been so different. I mean, if you look it up, it's like average inflation is 2.5%. Well, if average inflation is 2.5% over a 20-year window, well, then in theory over a 20-year window, if you design a policy right with the right company, you can see probably closer to 4.5% with the life insurance policy. So technically your purchasing power has gone up with the ability if you're putting it there versus somewhere else like a bank account.